Hello, thanks for joining me as we look at market vulnerability and we try to put a value to that, like how risky is the market or how vulnerable is the market. This is a culmination of several videos where we talked about the various indicators or factors that contribute to market vulnerability, and there were 10 of them. And we created 6 videos kind of describing most of these 10 indicators and how they contribute to vulnerability. So first up, and the most heavily weighted in our model are the valuation indicators, the CAPE ratio and the Buffett indicator. Of course, you recall that the CAPE ratio is our price to earnings smoothed over a 10-year period. The Buffett indicator is total market cap to GDP within the US. Liquidity is the availability of money, and highly influenced by the Fed and their money, their policies, leverage and credit, speculation, inflation, T-bill rates. Those are all catalysts. When you see changes in those, they could catalyze changes in the market and repricing in the market. And then as we move down, the weight goes down, but they're still important. Unemployment, fear and greed, consumer confidence. It's more leaning into the sentiment area. They're useful context, but shouldn't dominate the score. In fact, consumer confidence, you'll see, has zero weight right now. So what I did is we took these 10 indicators, assigned them a weight of how much they're going to influence this overall score, looked at their current values, compared that to historical context, gave it a score, and added it up. And you can see right now I'm saying that the vulnerability of the market is 80, and that's out of 100. So it's really quite high, but it could go higher, and we'll talk a little bit about that in a few minutes. But what a score means. So the lower, the better in terms of market vulnerability. But when it's low, it usually means the market is also low, but it could be a good time to jump in. When it's high, it means the market is probably very high, but it's also a very risky or vulnerable period. So right now, if we're at 80, we're saying expensive valuations, multiple risk factors, high probability of drawback in the coming years. We don't know the exact time frame, so this isn't a tool to time the market, but it is a tool to anticipate over, say a 5-year period, what's the likelihood of things going up or down. I think it's kind of like counting cards in blackjack. Just because the count may be in your favor doesn't mean you're going to win the next hand. Or if the count is in the house's favor, it doesn't mean you're going to lose the next hand. So it does mean over time, though, you may want to start increasing or decreasing your bets accordingly. So we're in the high range right now with the potential of moving into the extreme range, and we'll talk more about that in the coming slides. So what I did is I used this model and I applied it to historical timeframes to see what scores it would generate, to see if it's producing numbers that kind of matched reality, and then adjusted the weights of each of the indicators to see if it would give us the scores that matched reality. So for example, back in 2000, right before the dot-com bust, this tool gave a score of 88, so even riskier than we are today. Right before the mortgage crisis, it gave a score of 66, so not too high, but again, the mortgage crisis was kind of a unique situation that this model would not have captured. But then when we hit the low after that financial crisis, it gave a score of 18. It said, okay, this is probably a good time to start putting money in the market. And sure enough, it was, because we saw a steady, we saw 15 to 20 years of good returns, with the exception of the COVID surge, the peak of QE. This score was the highest score generated, and then where we are today, 80. So let's look at this for historical comparisons. Here's the numbers behind that graph. It just shows you, what the factors were that contributed to those scores. Actually, it was 89 at the .com. I think I had 88 on that prior slide. So it was very high. The only higher time was at the QE peak. And and then interestingly, I threw in the the time period right before the Great Depression crash. But that's not really applicable because margin rules were different. There were no circuit breakers. There was no FDIC. There was no quantitative easing. So it really didn't make sense. But I put it in there just because I was curious. But if you look at the peak QE period, that was the highest or most riskiest or most vulnerable score. And so that would seem to indicate that, that the markets were overvalued, they would probably fall. And no, the market didn't crash by 80%, but it did go down. It dropped 25% from its peak. It was one of the worst bond market withdrawals in history. A lot of speculative assets dropped, 50% over that next year. So that's why the evaluate or the risk or the score dropped because there were a number of things that changed. You can see liquidity went down, leverage went down, inflation went down. A lot of this was driven by the inflation surge. So that's why our scores today are better than they were in November 21. So what is this? What are the top risk drivers today? And what is this telling us? Well, obviously elevated valuations. We did 2 videos on this already. You could go back and look at those. We're at historically high elevated valuations. Not the highest ever, as you can see from our chart a second ago. They were even higher in prior periods, like around the .com boom and the QE peak. But it is still very, very high. The market concentration is also high. A small number of mega cap stocks drive a large portion of the market. This is risky. Inflation and rate pressures, and attractive risk-free alternatives. These two are the 2 areas that I see increasing in the coming months. So these will likely remain the same. These will go up. Our overall risk score will go up. And it'll be interesting to see how high it gets into the 80s, I predict, before there's some sort of correction. It probably won't climb as high as the .com boom because it seems like people are on more alert than they were then. They're already talking about the potential for the bubble. There's already a lot of talk of overvaluations and rising interest rates and what that means. So I don't think the speculation is going to climb and the exuberance is going to climb as high as it did the .com bubble, because I remember back then people thought, we were operating under different rules. The fundamentals don't apply anymore because we're under a different model. Well, that it turns out that wasn't true. And I don't hear people saying that anymore. I don't hear people saying that the AI is changing the way we should look at valuing the market. And so for that reason, I don't think we're going to see the score climb all the way to 89 before we see a correction. I think it's going to happen faster. But thank you for watching. Please join me as we look at upcoming events and anticipate what impact they'll have on this vulnerability score. And we can also continue to tune the model as we learn more about it. Right. Feel free to provide feedback, but even more important, if you like this video, please share it and please subscribe to the channel. Thank you.